Okay, so I have a new policy for international students because of the Fukushima disaster. So I understand your concern about Fukushima disaster and therefore related difficulties in staying in Korea. I fully understand that. Already several students left Korea. In relation, if you do the following assignment instead of attending this class, you can still have this chance of receiving not a best grade, but good grade. Okay. Submit midterm and final exam. Complete term paper by June 6, June 2011. Any question? Okay. Beg your pardon? How about what? Homework? You don't have to do it. Okay. Because if you don't stay in Korea and cannot take this class, I think it is almost impossible to do the homework. Therefore, that's why. Oh yes, that's true. Okay. So please tell Aurelia. Okay. Do you? Oh, you don't know her? Oh. Who is the friend of Aurelia?
I know already.
Oh, you know him? You know her? Okay. So, I think it is. I posted on the Google group, so it is likely that she will receive this note as well. But just in case, please tell her privately and personally. Okay. Also, Angelica. Who is the friend of Angelica? Okay. So, okay, you are the friend of Angelica, Kim Angelica.
I think this one.
But yeah, he informed me that you are her friend. So please tell her about this information.
So you not understand this?
Actually, so this will be posted to the Google group, which means that she is likely to receive the email just in case. Just in case it goes to spam folder or what. Okay, thank you. So thank you for other students risking your life and attending. Okay. So why don't you start today's presentation? Just a moment. Who is the? So 주현, Nina, Mindan. Okay. 주현, why don't you start first?
Hi, my name is Juyeon Kang and I will start my presentation from now. My part is the capital pricing model CAPM. The model of
capital asset pricing model, not capital pricing.
Sorry. Yeah, I made a mistake. The model of CAPM is a set of predictions concerning equilibrium expected returns on risky assets. And second one is assumptions. These assumptions allow CAPM more realistic and comprehensive model. First one is individual investors can affect the security price. They are just price taker. This is the usual perfect competition assumption of microeconomics. Second one is all investors plan for one identical holding period. The point is, the third one is no tax and transaction cost, and fourth is information is costless and available to all investors. Fifth, investors are rational mean variance of optimizers. And the point is that all individuals are similar except in initial wealth and risk aversion. And here is the model of CAL, which you've seen last class from Hammond's lecture. As you know, there are many CAL lines. However, the bold one is CALP. is the CAL with the highest reward to variability ratio. Because efficient frontier is the point we can select portfolio optimally. The point CAL and efficient frontier cross is the optimal portfolio. At CAL model, investors can make the return by taking on a certain level of risk, and the highest slope means the return is the highest. And the risk premium will be proportional to its risk and the degree of risk aversion of the investor. You can see this formula ERN minus RF. ERN minus RF equal A multiply variance, and with this we find that the risk premium on the market portfolio is related to its variance by the average degree of risk aversion. Capital market line CML is not quite different from CAL. While CAL model is the most efficient line, one investor make portfolio which consists of several assets. CML is all investors, all assets. And the point is M is optimal tendency portfolio on efficient frontier. This means that investors can skip the trouble of doing security analysis and obtain an efficient portfolio simply by holding the market portfolio.
Why? Can you explain why is this so?
Because this definition is from the assumption, and it should be equilibrium.
Oh, that's wrong.
No. Can I ask why no?
Okay, can anyone answer? Can you repeat what you said?
M is optimal tendency portfolio on efficient frontier. This means that investor can skip the trouble of doing security analysis and obtain an efficient portfolio simply by holding the market portfolio.
So M in the graph is tangency portfolio. It is a kind of line. There is a straight line. It is tangent to the frontier, the curve. The M is the tangency point. So M is called tangency portfolio. And give the assumption M is actually it should be the market portfolio. So graph means that individual investors can hold only M, which is both tangency portfolio and market portfolio, and risk free. Okay. So and risk free asset. The rate of the risk free asset is actually RF in the graph. So why is that? Can I just why? Why it is enough to hold only those two assets, M and risk free?
I guess the point N is the optimal risky portfolio, which means investor can choose with highest return when the lowest risk. And because it's optimal, there's no need to choose other portfolio. And the reason why we should choose risk-free asset is every investor's risk preference is different. Some could enjoy the risk, but others can avoid the risk. The risk-free asset help us to the level of the risk the portfolio we invest. I think that's the reason we don't have to care other assets than portfolio and risk-free asset.
Okay, so suppose in that situation, what happens if we hold another asset, other asset, in addition to risk-free asset at M? If we hold other asset, what happens?
And the CML slope will go down, which means we can't enjoy the efficient frontier line, which means the least variance and the highest return. Not highest return,
Okay,
given return.
Yes, correct. So if you make allocation only between risk-free asset and M, then between the weight on those two assets, you can have any position on this line. Okay. Of course, to have position in this point here, actually you have to borrow money and invest in this market portfolio. Then you can make position at the segment of this line. Okay. And suppose, so instead of holding only this and this, suppose you hold another third asset, because this is the frontier, so third asset should be somewhere here, right? Suppose, so you hold this, and if the ratio between these two is somewhere here, and if you hold the third asset, then your point would be somewhere here, right? It is below the line, below this line, right? So actually, you hurt, basically. Actually, you lose return, basically, given the risk you're taking. Okay, or you take more risk than the return you are enjoying, right? So actually, taking another, having position on another asset besides market portfolio and risk-free asset actually hurt your utility. Okay. So that's why investors want to hold only this and this. Okay. And this is called two-fund separation theorem. Anyway, continue.
So this is the capital market line formula. ERP is respected return and RF is this position and it is the slope. So this ERN minus RF divided by this and multiplied by this. So we can get the ERP. And this is also the slope. And this is SML is relationship between beta and return. Beta has the formula and at result it is 1. So market portfolio beta is 1. ERN minus market portfolio beta is 1 and ERN minus RF is market risk premium, and when beta is bigger than 1 is aggressive investment and beta is smaller than 1 can be defensive investment, and beta is 0 is risk-free. This formula, and this can be this, so you can erase, and then only remains 1.
Okay,
Is that enough?
Okay, let me test whether your explanation is good or not. What's the difference between CML and SM?
CML and SML?
Okay, so I'm asking questions to Uday.
CML is the formula or portfolio. Just RF. CML is invest in RF or market portfolio. Is the line of the SML is
The biggest difference is x-axis of CML is variance while SML is beta. So CML has systemic risk because other risk is raised by variance, while SML has unsystemic risk. It's not a standard aviation or variance. Contribute to offset to the portfolio variance measured by beta. CML is also composed of the market and the risk-free asset, and SML is graph individual asset risk premium as a function of risk.
So Nina, can you understand that? Yeah, okay, why don't you explain again? That's important.
Actually, the formula is very similar. Like, there's no.
Yes, so everyone should understand this because I'll make you homework. I'll give you homework.
Okay, here is CML model. The formula is RF plus this slope multiplied like this deviation variance, standard deviation, this with this difference. So this is SML model, RF plus this slope multiplied by beta. And also big difference is CML is composed of market and the risk-free as all of the market and risk-free assets, but SML is individual asset premium as a function of risk. Is it more
Okay,
clear?
what is the slope of SML?
Sorry?
What is the slope of SML?
Slope? Slope is that ERM minus RF divided by 1.
So what is that?
What is that?
Yes.
That is the slope.
Yes, so there is a terminology about that term, okay?
Yeah.
What is that? What is ERM minus RF? divided by 1, which is just ERM minus RM. What is that?
ERM is the expected return. However, risk-free is the risk-free asset. So we have to ERM minus RF.
Yes, so ERM is the return from market portfolio.
Yes, expected
RF
return.
is risk-free rate. What is the difference between expected market return and risk-free rate? That is called market premium. Right? So slope of SML is market premium. What is the slope of CML?
The most efficient asset.
Yes, so what is the slope of that?
Slope is also similar.
Yeah, similar was different. Okay. Okay, write down the equation for the
Yeah,
slope.
so there is no.
Yeah, write down the equation.
Okay.
Sorry.
Thank you.
I think that's not correct. Good. Yeah. No,
No, this one,
but this is better.
this one.
The slope of SMA is 1.
Right?
Okay, I see you. Thank you. So let's take a look at this graph more carefully. Okay. So yes, you can go to your see. Okay. So about this graph. Okay. Why it's very slow. Okay. Okay, so this is CML, capital market line. So X is basically standard deviation of an asset or volatility of an asset. Y, X, is actually portfolio, okay? Y-X is actually expected return from portfolio. So if we write down, so this is CML, so if we write down equation for CML, it looks like, so RP, okay? Okay, so let's say RP is your return of your portfolio, which should be like RF. So this is RF plus, okay, ERM, ERM minus, okay, so this is ERM, so RF. So slope of this line should be this difference between this and this, right? So divided by SM, okay, SM is sigma actually, and multiplied by SP, okay. S is portfolio, so it is annoying to write down sigma. It is better to write down here. So this is almost right. So if you see this is almost right, but it's not E. Okay, this is important. It is return of the market portfolio. It is the standard deviation of the market portfolio, right? So this is the slope. Okay, and so this is X, this is Y. Okay, this is the slope. And if we take a look at SML, SML is basically capital asset price model. So expected return of your asset I or any stock I should be M multiplied by beta of your asset, right? So this is your slope. So this one and this one looks similar, but the only difference is this part. So anyway, this part is called market premium. It is premium of your market portfolio. So it is excess return of your market portfolio over risk-free rate. So it is therefore called market premium. And this one is market premium. So this one is market premium, and we divide market premium with volatility of market portfolio. So this one we call it market price of the risk. Okay. So for CML, the slope is market price of risk. SML, slope is simply market premium. I think this is yours. Okay.
I think this SML means maybe price, maybe actual price for taking some risk, but I'm not sure what CML means. Could you explain this again?
It is just a capital market, right? It is, you can think it is efficient portfolio. Okay. It is set of efficient portfolio. Okay. And it's a relationship between return of any asset and the risk of that asset. Here, risk is beta. Okay. So it is a simply linear relationship between your beta and expected return. Yes?
You asked about the difference between CML and SML, and the presenter said that SML has non-systematic risk, but it's linear, right?
So, okay. About non-systematic risk, so if we believe capital asset pricing model, so actually we put expectation over here, but we can write capital asset pricing model without this expectation sign, actually without this expectation operator. In that case, capital asset pricing model says that RI, okay, which is return of the asset I, can be decomposed into risk-free rate plus compensation to the risk, compensation to the systematic risk, beta I, and market return minus risk-free rate, and plus idiosyncratic risk. Idiosyncratic risk. And therefore, if we put just expectation over here, and we get the same thing, and idiosyncratic risk is basically, it doesn't matter. For the expected, not real return, for the expected return of your individual asset. Okay, so this part is called systematic risk, and this part is called idiosyncratic risk. And this part will be diversified away if we have many assets. Okay. And in the capital market line, basically, in the capital market line, we are assuming many portfolio over here. Okay, actually, it's not necessary. Okay, it's not necessary. But if we have many portfolio, then basically in this market portfolio, the idiosyncratic risk will be zero. Okay, will go over there. But actually, we can write down this capital market line with only two assets. Actually, that is also possible. In this case, even in the case, this tangency portfolio is not same as market portfolio. Right? In the case, the tangency portfolio should include idiosyncratic risk. So anyway, tangency portfolio becomes market portfolio if we draw this line with all the assets in the economy. Okay? With all the financial assets in the economy. Then tangency portfolio should be the market portfolio. If we don't include all the assets in the economy and through the capital market line, then that tangency portfolio is different from market portfolio and likely to include some idiosyncratic risk. Anyway, I'll give you a data set and you have to draw this one next class. Anyway, next presenter.
Well, to just recall the class, what is a bond? A bond is a security that is issued in connection with a borrowing arrangement. So the borrower issues to the lender for some amount of cash. So the borrower issues a bond to the lender for an amount of cash. And this arrangement obligates the issuer to make specific payments on specific dates to the bondholder. So when the bond matures, the issuer repays the debt by paying the bond's par value or face value. And you also have the coupon rate, which we also have discussed already. And that's the bond's annual interest payment per dollar of face value. For example, if you have a bond of $1,000 like this, and the coupon rate is 8%, and that means that you receive $80 a year. But normally in investments, you receive it semi-annual, so it means you receive per half a year, so it's $40, which is 4%. It's very easy. And for example, if a bond matures after 30 years, then you receive its face value back again, which is $1,000. There are two kinds of treasuries, treasury notes and treasury bonds. One is the first one, treasury notes, matures between 1 and 10 years, and treasury bonds matures between 10 and 30 years. And this highlighted part from the picture, it matures in January 2012 because it's the year 2012. And so the bid price of the bond, you can see under bid, it's 100 divided by 10. So it's 10 of 32 because, yes, just because. You calculate it by using this one. So if the bid price is this, then it is so this is the percentage of the face value, and this is equal to $1,003.44. However, this bond price, this price, is not the actual price paid because the accrued interest is not included in that, and accrued interest is an annual coupon payment divided by 2 times the days since the last coupon payment, and then divided by the days separating the coupon payments. So, for example, if 30 days has passed since the last coupon payment, there are 182 days in a semi-annual coupon period. The accrued interest is 30 days by 182 days. So if the rate is 8%, the semi-annual payment is $40, like here. It becomes $40 times which is, so this is the accrued interest. And after that, callable bonds are bonds that you can repurchase by the issuer by a specific call price during the call period. So, for example, if a company issues a bond with a high coupon rate when the market interest rates are high and the interest rates later fall, the firm might like to retire the high coupon debt and issue new bonds at a lower coupon rate to reduce the interest payments. So this is like very good for the firm, but not good for the investor. So most of the time these call bonds have a higher yield. And then there are convertible bonds, and it gives a bondholder an option to exchange each bond instead of for money for shares of the common stock of the firm. So if the firm is short on cash, if the bondholder can exchange the bond for shares instead of cash. So, for example, if the face value is 1,000, and the current stock price is $20 a share, and you can exchange it for 40 shares. It means that you make a loss because it's just $800. But if, for example, it's $30 a share, and you can also get 40 shares, it means that you can get $1,200 worth of stock. So that means that you kind of make a profit. You have also putable bonds, put bonds. and it gives the holder the option to exchange for the face value at some date, or extend it for a number of years you want. So, for example, if the bond's coupon rate exceeds the current market yields, the bondholder will choose to extend the bond's life. And then floating bonds, those bonds make interest payments that are tied to some measures of the current market rates. So, for example, the rates might be adjusted annually. So the current T-bill rate plus 2%. So if it's now 4%, then next year it's 6%, and the year after that it's 8%. So the bond will always pay the current market rates. We have preferred stock. It is considered to be equity, but it is often included in the fixed income universe because it promises to pay a specific stream of dividends when the company fails to pay the dividends. And when the company fails to pay the dividends, it just accumulates. So, yeah. So you don't get, like, maybe you don't get it now, but you get it later anyways. And the preferred stock, there's a fixed dividend. So, yeah. And you also have floating preferred stock, which has been more popular. This means that the dividend rate is linked to a measure of current market interest rates. And for example, when a firm buys stock from another firm, it pays only 30% of taxes. So the firm's tax rate can be 35%, and it receives $10,000 in preferred payment dividends. And that means that it will pay taxes only on $3,000. And the tax of this, because it pays tax on only 30%, so the tax is so they pay only taxes for $1,050. So actually, the tax rate is just 10.5, and because of it's very good for them and profitable. Many firms hold these preferred stocks, and there are two kinds of international bonds. You have the foreign bonds and the euro bonds. Foreign bonds are issued by the borrower from a country other than the one that is in which the bond is sold. The bond is denominated in the currency of the country in which it is marketed. So, for example, a Dutch firm sells a dollar-denominated bond in the US, and the other one is the euro bonds. These bonds are issued in the currency of one country but sold in other national markets. So, for example, denominated yen bonds are not sold in Japan but sold in another country. And, for example, the dollar-denominated bonds are not sold in the US but also somewhere else. And there's a lot of this new trend is happening, bond innovation. I've summed a few. Inverse floaters, they are similar to floating rate bonds, except the coupon rates of these bonds fall when the general level of interest rate rises. So this formula is like this. So the bond value is the present value of coupons plus the present value of the value phase. So if the maturity date is T and the discount rate is R, you can write it like that. This is the maturity date and the discount rate. No, this one. I'm not sure. And the second formula is for the present value of the single amount, final payment of the bond's face value. So if the present value is $1 annuity that lasts for T times T periods, then the interest rate equals R is and this is also called the T period annuity factor for interest rate R. And you have also the present value factor. That is so if you put it all together, oh, where is it? You get a very big one. So the price of the bond therefore can be written as the price So this is like the price of the bond, how you can calculate it. And then we have this figure. At a higher interest rate, the present value of the payment received by the bondholder is lower. Therefore, the bond prices will fall as market interest rate rises. So this is like a general rule in the bond valuation. So this slope is downwards. And this is because the present value of the bond's payment is obtained by discounting at a higher interest rate. So this figure shows the price value, the price of a 30-year bond, and at a 8% coupon rate, and it sells at face value. It sells at $810.71. This one is this number. So the negative slope illustrates the inverse relationship between the prices and yields. And then the yield to maturity, YTM, was included in the homework a long time ago. It's defined as the discount rate that makes the present value of a bond's payment equal to its price. The yield for maturity is a standard measure of the total rate of return. So to calculate the yield to maturity, you have to solve the bond price. So you have to, like this equation, and then you have to solve this one. And then compound rate of return, it means that all payments will be reinvested. So if you have like interest rate of 10% and you have a face value of $1,000, the bond will grow after 2 years to 1,210. Because if you have 1,000, it will be with 10% after 1 year, it will become this. So if you reinvest this 100 will become 110. And if you accumulate that, it becomes so this was my presentation.
Cool. Any questions?
Well, you introduced us callable bond.
Yes.
You told us it's bad for investors. Can you explain the reason why?
Yeah, because the callable bonds are bonds that they can repurchase. The issuer can repurchase it at a specific price call during the call period. So, for example, if the bond has a high coupon rate right now, but later at a later time, if the company has a high coupon rate when the market interest rates are high, and the interest rates fall later, then the company who issues the bond can ask for a refund, resell it, some kind of. So it's like the investors expect to get this, and this, but the company can have this option that when it's lower, then it can be changed. So that's bad for the investors.
The reason why I asked these questions, of course, the predictability to cash flow, future cash flow is harm, right?
Mm-hmm.
Yeah, because the issuer wants to buy the bonds back, but what if the issuer pays the investor enough money to investor?
Excuse me?
Yeah, I mean, as an investor,
Yeah.
the fixed cash flow in the future is very nice because it's very it's predictable.
Mm-hmm.
But
Yes, but
callable bond case,
Mhm.
because the issuer wants the bonds back.
yeah.
The-
Um,
yeah, there is some risk. Yeah.
Yes.
I mean, yeah, but it's bad for investor. But
yes.
when the issuer pays investor enough money to convince the investor, yeah, could it be covered or?
Yeah, well, they kind of balance it with higher interest rates on these bonds. So the investors actually bear this risk that the issuer can call back these bonds whenever they want, but they also receive a higher interest rate. Was that your question?
Okay.
High yield. High yield, not high interest.
Then I wonder the callable bonds price is it
Huh?
how about the price of color bond? I think it must be it must have some premium, because he sure can buy back whenever he wants.
I can't hear, sorry.
Sorry. Whenever he wants.
Yes,
Right?
yeah.
Then I think there must be some premium in the color bond because it has
I have
other
no
option.
idea about that.
Okay.
Any more questions?
Can you go back to the slide where you have all the different kinds of bonds?
This one?
Yes. Can you explain more like inverse flow?
Yes.
That was not using.
These are similar to floating rate bonds, so they're tied to the market, how the market is performing. But the coupon rates of these bonds, they fall if the general level of interest rises. So when the interest rises, the coupon rates falls. But it's also tied to the market. Okay? Any more?
What is a gas market?
When, for example, natural disasters happen, so for example, war or an earthquake. So when this happens, the investors will lose their money, but they kind of bear the risk for this. Like it's a transfer from insurance company to the capital market. So these bonds are like the transfer way. So and to bear this risk, they have a really high interest rate. So it's kind of balanced.
Okay, thank you. Why don't you take a 15-minute break and inside the meeting, complete it.
Hello, my name is Winsang Park. I'm a senior in business major. Whoa. Sorry, it's a little slow, the computers. There is a blind deer. Do you know what we call the blind deer? Any idea? Blind deer, the deer that cannot see. Do you know what we call the blind deer? Yeah, deer, animal. No. Do you know what you call a blind deer? It's called no idea. But my first thing that came to my mind when I saw arbitrage pricing theory, I thought of the blind deer. I had no idea. But my goal here is to not to explain everything about arbitrage pricing theory, because that will not be my role here. But my role here is to make you understand the basic concept and also how to very basically calculate a little bit of arbitrage pricing theory. And this is my motto: face up to reality, but never forget your dream. And I just face up to reality, but my dreams kind of got crushed because it's kind of difficult. I'll try my best. Okay, so what is APT? Today, our previous presenter talked about CAPM, and CAPM basically is criticized actually because it's difficult to select the proxy of the market portfolio as a benchmark. And so the scholars actually thought about they were searching for the alternative pricing theory, and they needed fewer assumptions. So the production was the arbitrage pricing theory. So based on the law of one price, the two items, maybe two assets, they are the same, cannot sell at different prices. And if they are different, that means they are they are in equilibrium. So if they sell at a different price, an arbitrage will take place. So in which the arbitrators buy the good which is cheap, and they sell the one which is higher. And what will happen if this happens on and on? If
The price will be modified.
yes, the price will be modified and will be the same, and we will reach the equilibrium. So what are you talking about, little man? That's maybe it's like I can see in your eyes. You're wondering, and we have assumptions. 3 major APT assumptions. First, capital markets are perfectly competitive. And the second, the investment always prefer more wealth to less wealth with certainty. And third, the process generating asset returns can be expressed as a linear function of a set of k-factors of indices. K-factors or indices. Indices are the plural form indexes, because that's the first time I found about this, the plural form of index. But also, we don't assume something in APT. 3 non-APT assumptions. First, market portfolio that contains all risky assets and is mean variance efficient. Also, there are normally distributed security returns. Also, non-APT assumptions. The third one is quadratic utility function. You know what quadratic utility function is?
Utility functions cannot explain in English, but yeah, it's kind of form of utility function. Yeah.
Okay. Quadratic utility function is actually in a normal form is this. So
I can't see.
this is the normal form of quadratic utility function. Moving on to the next slide. So we have multiple factors actually. So multiple factors are and they are expected to have an impact on all assets, such as inflation, growth in GDP, or GNP, but normally we use GDP nowadays, and major political events, such as what we did for the midterm, the Korean Peninsular incidents, upheavals, and also interest rates, and there are so many. And the contrast with CAPM is CAPM insists that only beta is relevant, but like in APT we have so many factors. But also I believe that these factors are quite hard to calculate though. But I think there are many researchers and scholars actually building these numbers and trying to realize the relations. Now, this is the very difficult part for me. Well, these equations, yes. So we are now trying to get the rate of return of I asset, and ERI is expected return of I, and B is expressed as B1, B2, B3. They are the reaction in asset I's return to movements in a common factor. Let's say it's kind of sensitivity. Is that clear? It's kind of sensitivity to some factors such as inflation or growth in GDP. And FK is a common factor with a zero mean that influence the returns on all assets. It's a common factor that influences all assets, all assets. And I didn't know what it meant, but EI is idiosyncracy. Idiosyncratic risk. Yes, idiosyncratic risk. I was gonna actually say big E, but idiosyncratic risk is a unique effect on assets I's return that, by assumption, is completely diversifiable in large portfolios that has a mean of 0. So it's basically same as what Professor Kang told us from the previous presentation, that as many, the more the portfolios we have, the better, the lower the risks are. So I like to give example of two-factor model, and we go back to the slide. So we just look at this alphabet, and it very confuses me a lot. So I brought this very a small, easy example, and I want to solve that example in front of all of you. Is that okay? So let's assume that the rate of return is defined with two risk factor, and there are two well-diversified portfolios, and risk-free rate is 5%. Can you see this? And also, let's call B1 and B2. We can go up to so many factors, but let's just say we have two risk factors. B1 is the sensitivity of one factor, and B2 is sensitive of the second factor. And let's say this is so now we have two portfolios. A and B. The expected rate of return is it visible? Is 9.25% for A and 8.75% for B. Now the sensitivities for BI1 and we have BI2.
Their sensitivity, right, for beta terminology, factor loading.
Can we call that beta 2? Is it possible?
Yeah, that's fine, but we call that factor loading.
Factor loadings?
Yeah.
Okay, factor loadings. Okay, factor loadings. For 1
Yeah.
is and for portfolio A is 1.0, and for portfolio B is 0.5. And factor loading for factor 2 is 0.5 for portfolio A and 0.9 for portfolio B. Now let's say there is an asset called C, and it has weighted average is 1 because we only have one asset, and its factor loading is for asset C is 0.8. And let's say that the expected rate of return is 8%. Now we are going to duplicate this this asset, and we're sharing the same fund amount and also the same risks. Let's call it portfolio. It's a portfolio of A and B, we're going to use this data here and duplicate this asset here. So what we have is weighted average. What do you think the weighted average will be? Here. Can you guess any number? 1. Yes, it's 1 because it has to be same with this. And now we are going to use this number here, and I'm going to use the equation there and say weighted average here times BA1 and plus weighted average of B times B and for B, weighted average of B1 plus weighted average of B times B1. Now it becomes weighted average because we still don't know what the numbers are, right? We still don't know the weighted average for A and B, so we just use this number and times what was factor loadings for BA1? Yeah, it's 1. Plus weighted average of B times 0.5. And here we do the same thing, weighted average of A times this. Times this. Can you see? No? Okay. So we actually use a number here, so it's not going to confuse you. And because we're running out of space, I'll move it up here. No, so if and expected rate of return was I didn't actually say one thing. Oh. For SSC, I didn't mention one thing. The BC1 is 0.8. And we have to have BC2. BC1. Because we have 1 and 2, right? We have 2 factors. That was my mistake. I only put the factor loading for 1 factor, but we have to have 2 factors. So let's assume that this is 0.66. So as I told you, we have number 1 here. That means we have to make this same. Also, we have to have this same. So these numbers should be 0.8 and 0.66. Do you follow me? Right? And there are a lot of calculations here, but you know what we do here? We have to double this entire thing and then minus the low here, and then we also subtract 0.8 times. It'll be something like 1 point something and minus 0.8 is, and then I have the final number is so when I calculate all this, and weighted average of A will be 0.6. Okay, and what this will be? Yes, it will be 0.4, and it becomes 1. So we have this, and now what we have to do is get the expected return. We have to find out the rate of return for this portfolio, and what we do is we use the expected rate of return for each portfolio. So now we have weighted average 0.6 times for portfolio A. What was the rate of return, expected rate of return
9.2.
is 9.25 plus 0.4, the weighted average of B, times yes 8.75%. And the number we have is 9.05%. So what we see is we actually use this duplicated this risk and the factor floating, but the rate of return is higher than the expected rate of return of SSC. So what happens in arbitrage pricing theory is that arbitrageurs look at this and say, oh, you have the rate of return is higher here. What you do is you sell this asset and you buy this. How do you do that? How is this possible to sell this and buy this at the same time?
Short sell.
Is it called short sales? Maybe public auction?
I'm not sure.
공매? Is this short sale? 공매?
Short sale.
Yes, short sale.
Short sale.
Short sell. So we actually don't have to borrow money or wait until we wait until we kind of save money. We short sell on this this asset and we buy this at the same time. Then what do we have? The arbitrage. What will be the arbitrage? We have the arbitrage of 1.05%. And later it will change, right? Because when they start doing arbitrage trading, then the difference, the gap will be lessened. It will narrowed. But until then, until it reaches the market reaches the equilibrium, this theory tells you that these arbitrageurs will constantly start doing selling and buying the two different assets at the same time. Did you understand everything? Are there any more questions?
I don't understand 1.05%. How can I? Minus.
Yes.
Okay.
Oh, okay. So we buy 9.05% the asset. It was the portfolio that we calculated using the depleting the SSC and minus 8.0%, and this we sell. So at the end, what we earn is the gap between these two rate of return, which is 1.05%, and that will be the capital gain for the arbitrators. And any more questions?
Wrote it down, but as you told, APT is kind of pricing theory, right? With those arbitrage, how the asset could be priced? You showed us the procedure of arbitrage, with factor loading and expected return, but I'm not sure how the asset price is made.
To be honest, I didn't understand the next part. With my high school math skill, this is as far as I can go. So, but I'm sure if you have any ideas more, then you're free to come out here and then actually enlighten us. Is it possible? I can erase the board if you can.
Okay, thank you. So basically, to answer your question, through APT we know what should be the return of your asset. Since we know, so for this SSC, what is the return? This shouldn't be right. This is not a correct return. So if market to be equilibrium without any arbitrary opportunity, given this computation, actually the return from C should be 9.05%. Actually, right? Actually, if this is large portfolio and it's just one asset, then actually this shouldn't move and this should converge to this, right? So what does that mean? What should happen to stock price C?
Goes down.
Stock price should go down, right? If stock price today is low, it should jump down, right? Then we can expect higher return. So high return implies no low price today. So anyway, thank you. So I think yes, capital asset pricing model, APT, multi-factor models are all very important and maybe hard, but there is easy way. There is a way to understand them very easily. Okay, that is you can do homework. So homework is okay. So once you do the homework, I think you can understand them very well. So do you know? Could you please raise your hand if you learned regression? No. Okay, then you can learn regression. Okay, so you have 3 homework. Actually, only 2 homework: estimate beta of a selected asset and derive CML and SML. Okay, using the data over here. So if you click this Kenneth French's web page, okay, Kenneth's web page, and then you can go. There is a Pharma French benchmark factor. Okay, so actually let me write it. Actually, I don't have to write it down. The better one is capital asset pricing model. Okay, capital asset pricing model, and then Pharma French factor model. Pharma French 3-factor model. Okay, good. So first one is to estimate the capital asset pricing model, and second one is to estimate this one. Okay, so actually to compare Pharma French 3-factor model and capital asset pricing model, actually in capital asset pricing model we don't have these 2 terms. We don't have this one. Let me pull it up. So in capital asset pricing model, we assume that this is 0 and this is 0. Okay, and alpha is epsilon, so it should be 0. And Pharma French 3-factor model, it has additional 2 factors, this one and this one. Okay, so what you have to do is first, you can go like Google Finance, google.com, okay, and download any stock data like Ford, and you can go Ford historical prices, and then you can download historical closing prices, right? Once you download historical closing prices, then you can turn that into asset return, right? Ratio for the price asset return. So you can transform that into return, okay? Subtract and divide, okay? Then you have a return, and you basically, if you do that, then you have return for actually you have this part, okay? And all you have to do is estimate this one
Professor,
and this, yeah.
which historical price do we use?
So please use closing price,
Oh, which?
anything, yeah, like anything, okay? But since is this Kenneth French's web page is all about US data, you have to download the US stock. Actually, stock price is stock that is listed in US market. Okay, you download and run the regression and estimate this equation and estimate this equation. Actually, yeah. So first estimate this equation and second estimate only this part, assuming this is 0. Okay, and I'll show you how to do that. And about you can easily download stock return. Actually, you can download the stock prices and you can turn them into the return. So this part is easy, but you need risk-free rate, market return, and SMB and HML, And that one you can go data library. Okay. Okay, here it is. Find a French factor weekly and daily, and so I mean it is up to you. You can use either weekly data or daily data. Let's take a look into the daily data. Okay, and if we open this, I hate V3 zip. Okay. Man. Okay, fingerprint data factors daily. Okay, and okay. So if you open this, here it is. So this one is a market return minus risk-free rate. So it is market factor. So this first column is this one, okay? The first column is this part, right? This KM minus RF thing. This second one, SMB, is this one. Okay, this third one, HML, is this one. And you will need risk-free rate, and risk-free rate is here. That's easy, right? And then you have to estimate this. In capital asset pricing method, only this one. Okay, and I will show you how. Before I show you how to do that, let me explain briefly about these three factors that is very famous. The first one is very simple. It is the market excess return of the market portfolio over risk-free rate. Risk-free rate is easy to compute. It is like short-term government bond, payoff from government bond, and this is the return from portfolio. Theoretically, it is the return from portfolio composed of all the assets in the economy. Okay, so difference between the two is called market factor, and this SMB is basically small minus b. So it is basically return difference of the two portfolio. S means so small minus big, and small means small firm, big means big firm. So it is excess return of the small firms over large firms. Okay. So it is like a cost P200 minus cost of something like that. And this HML is high minus low, which means that high book to market ratio firms minus low book to market ratio. So high book to market ratio firm, we usually call it value firms, and low book to market ratio firms are often called growth firms. Therefore, this HML is basically premium, okay, premium of value firms over growth firms. There are many ways to calculate this size factor SML and HML. Okay, but you don't have to worry about it because in Kenneth French's webpage, it is already computed, right? Like this. Okay. And so you have this data, and all you have to do is match the date. You have to match the date. Okay, match the date and add your return data, any asset, and to the regression. About regression, actually, it is very easy. You can even do that with Excel, basically. If you want to use Excel, please use Excel. But actually, I suggest you to use basically R. So I'll illustrate you using R. Okay. So.
Professor?
Yes.
Do you mind if I videotape this because I'm forget all the time when you explain how to do the homework?
Beg your pardon. You wanna?
I want to videotape how you show.
Yeah, that's fine. Yeah. Yeah. Please. Actually, and so if you need a video content, you can ask Minsan, okay? Okay, so please make it available to other students as well. And then I think it is temp, okay? And then let's make edit. Regression, okay. ff3, okay? ff3.r. And then first, this, okay. So first, I mean, it takes too much time to download the data, and so I will simulate the data, okay? So I'll use simulated data, but you have to use real data. So first, let me simulate risk-free rate. And let's assume risk-free rate is just, okay? Let's T is, let's say, 100, 1000. Actually, 1S is only 100. So which means I use 100 day, actually year data, okay? 100 year data. And then okay, so I use 100 year data and RF. So I have to simulate RF such that RF is, let me say it is a T. Mean 0 and standard deviation, something like that. So I simulate it is 100 data with mean 0 and standard deviation 0.01. Okay, so I mean it is risk-free rate should be less volatile. So let me see how does it look like. Actually, so right, small forms. Small form is R norm T 0.2 and then higher volatility like 5. Okay, this is a small form return from small form portfolio and large. Okay, large is R norm. Okay, T and this one is 0.05 and low volatility about 0.2. This is return from large form portfolio. Okay, and now I need high. High is R norm. Again T now 0.15 and 0.4. Okay, so it is a, let's say it is return from value from portfolio, and the low is R norm T. Okay, no, this is not fun. Okay, 2.5. Okay, this is the return from growth from portfolio. So now I have to construct, okay? Now I have to constitute market factor SMB and HTML, right? So first market factor is simply RM minus RF, okay? Which is, it should be the same to this one, okay? MKT minus RF, okay? And SMB, actually this is already available here, but I'll show you the process. SMB is simply small minus.
How do you draw graph?
Oh, okay. That is so let me show you with this one. So from this example, okay, first let me show you only one thing. So how to draw SML. So this SML is okay, it's SMB and SML. So how to draw SML? So in SML, basically SML looks like ERI equals to RF plus mkf multiplied by beta I, right? Right, so all you have to do is write a small function such that SML is something like a function, input variable is beta, and then, okay, beta such that, well, actually we have to calculate average of the MKF, so, no, mean, okay, mean MKF, okay. Let's write down MR market premium. Market premium is just mean of here MKF, right? Then beta is this one is should be SML equal to R. Let's say RFP equal mean of risk-free rate. Okay. So basically this one is RFP plus MKP multiplied by beta. Okay. So theoretically you have code for SML. Okay. So for a given function like SML 0.1 would be have value something like, oh, why did we have, sorry. Let me execute this one again. Okay, so SML now, for when beta is 0.1, expected return should be like 0.2, like something like that. So we can write a graph such that for beta is, let's say beta is, so P is like a sequence of 1 to 100 divided by 100, okay? If you do this one, you have B something like this. And what you have to do is you have to throw something like Y. Y is something like SML of the B, right? So basically, Y is the expected return for different value of B. Y should be look like this. All you have to do is now draw the graph. So plot something like Y. Actually, I don't have enough time. So plot Y, then it should look like this. This is not so good. So I type L, then let's say then we have straight line. But of course, you have to now change it. So Y is fine, but now you have to change X to. This is fine. Beta is from 0 to 1, so it is, you can regard it as a percent of the beta, right? So making more fun, you can make changes to 200, then we make beta variant from 0 to 200%, right? So if we do this again, okay, so plot would be like this. So basically it is a security market line, SMA. So this x-axis is beta. When beta moves from 0 to 200%, and this y is the return. What should be expected return of an asset for with different beta? So this is SMA. Okay, and you have to do the same thing with CML. Okay, very easy. I mean, homework is very easy, right? This is your homework is basically only this part. Okay. I almost gave you the answer. All you have to do is to download the data and match the data and learn this kind of program. And then how to draw CML and do your own work to yourself. Okay.